Welcome, everyone. Another episode of Financial 15, the show where Kevin and I try to provide some financial knowledge, something that can help improve your situation. And we do all that in 15 minutes or less. And today we're going over the rent versus buy decision. Should you rent your house? Do you buy the house? It can get a little complicated. We'll provide you a few keys to help answer that question. Stick around.
Again, another topic we have that really has no right or wrong answer, but we want to point out all the basics here, forward and backward. Again, if you wanted to see this video or any of the other ones that we produced, or you want to know anything more about what we are, go to our website at beckerorr.com, or please look at our YouTube channel or like us on Facebook. We have all this information there, and we're more than pleased to share it with you anytime we can. Now, Clint, renting, buying, how do we decide what we want to do?
There's lots to that question. We're going to get into some of the mathematics, plus give you a few other non-mathematic options to consider. But why don't we just start out with the basics here, Kevin? Let's go through a few of the reasons to buy and a few of the reasons to rent. I'll pull this up. Walk us through this here, Kevin. Someone comes and says, I want to buy. What are the positives? What are a few of the reasons someone should be looking to buy a place?
Yeah, I mean, some of the reasons, I mean, this is not your parents' sort of scenario where, you're throwing money away if you just rent it. You got to buy. But there are good reasons to buy property. One of the main ones up front, as we say, building equity. So as a homeowner, your property appreciates over time. There are times where it's just going to be stagnant or not. But if you do the math over a longer period of time, houses appreciate. All we have to do, I mean, if we want to take a look in this country, is go to Toronto or Vancouver. 20 years ago, what's the price today? You've had huge appreciation. So you've built equity in that home. The other factors, there are things along the lines of stability. You actually own something. When you rent, you're paying to a landlord. You are the one, you don't have any say as what's going on. If you own the house, you can do all the changes you want, painting colors. I want to renovate this. I want to do that. You are the one making the decisions. You don't have to worry about anyone else. And a third point to mention is where we talk about a straightforward investment. Now, a lot of people may not think of it this way, but basically what you're doing is you're buying a private leveraged investment. You pay a mortgage up front, so you keep paying and paying and paying. It is the largest leveraged investment you will probably have of your life. But when it's all paid off, you own the property. That property is theoretically an investment, even though a lot of people don't think of it that way. We've mentioned again beforehand with the building of equity, as you can see, you own something now that has a value to it that is all yours. So these are some of the main reasons we want to buy. Anything else you want to add on that, Clint?
Well, let's flip the coin here. Let's look on the other side. So reasons to rent, right? There's positives to each situation. You nailed the positives of why someone would want to look to buy, want to own the asset. Reasons to rent. One is flexibility. Often leases are about 12 months. You're not tied down for an extended period of time. You can change your mind. You can move around if that's your desire. Often it's cheaper. Rent is typically cheaper than mortgages, and there's less headache. You don't have to pay property tax. You're not doing yard work. Generally, you don't have to do any of the house maintenance. All of that kind of stuff can be a drain on your time. It can be a drain on your wallet. And if you're a renter, you don't have to worry about it. So it can be less of a headache. And the last point here, Kevin, if it is cheaper and you're not paying property taxes, well, you should have a little bit of extra cash flow. Now, what you do with that cash flow, everyone's going to be a little different, but there's an opportunity there for investment. If you look at buying versus renting, you say, all right, renting's cheaper. The extra money I'm saving, I'm going to put that towards an investment. I'm going to put that towards a business, or I'm going to get education to improve myself so I can get a better paying job, whatever you do with it. Now, if you just spend it, different story, but the point is there could be some extra money. If you're renting, you could use that extra money for an opportunity to invest. So quickly, there were reasons to buy, reasons to rent. Let's get into the comparison. And I think up front, Kevin, I'll throw this question to you. Can we just look at the rent and look at the mortgage payment and compare the two? Is that apples to apples?
No, they definitely are not. You're not looking at the same thing here. I mean, everybody wants to compare them and, I pay this, I pay this. Oh, it's equal or it's not equal. One's better than the other. There's a lot of differences. I mean, in a mortgage, you're dealing with things along the lines of you're paying a ton of interest up front before you start actually paying off a lot of that principal for anybody else. Whereas the rent, this is a certain amount that you're going to get, and those are set by different boards. So you could have rent increasing all the time where your mortgage payment's locked in for, say, 5 years. So you don't have to worry about any of these sort of scenarios. So there's a variety of different analyses, but we're not dealing with an apples to apples comparison by any stretch. What other points are there that we've got to look at for this?
Yeah, so to try to make it an apples to apples comparison, we have to look at a few other factors. And now this comes from Ben Felix of PWL Capital, the idea of a 5% rule. So let's look at those other factors, see if we can use some mathematics here so we can do an apples to apples comparison. Now, some of the differences, if you buy a property, well, you're going to have to pay property tax. And that's not related to, it's not going to increase the value of your home if you pay property tax for 10 years. It's just money going out the door because it's part of buying the house. It depends where you buy, but usually you're looking 1.5% of the value of the home. That would be your annual property tax. Same with maintenance. Hard to get good numbers of what an average year would be for house maintenance, but roughly 1% of the value of the house makes some sense. So you can see right there, we're looking almost 2.5% of the value of a home every year, just going to maintenance and tax. And then we get into the cost of capital. This is a little more complicated, but you can break it out into cost of debt and cost of equity. The cost of debt there, Kevin, it's essentially the interest on the mortgage. Most folks borrow money to buy a house, and now they're going to have to pay a cost for having that borrowed money. That's the interest you pay. And now, nowadays, you're kind of 2 to 3% on the cost of debt. And then the cost of equity, that'd be the equity in the house. So let's say you borrowed 80% of the value, you've got 20% equity in there. Well, that's a choice to have an investment in a real estate property, in equity. And there's an opportunity cost to that. You could have done lots of things with that money. The concept here is you put that money into the house, and it's going to have a certain rate of return going forward. Now, without getting into the complicated mathematics, there's going to have to be an opportunity cost of that, real estate versus, say, stocks versus bonds versus other assets. And you generally end up in a kind of a 2 to 3% range. And you can see you can add those up, and that'd be roughly 5% of the value of a house. We'll go through an example here, but before we do, did you want to build on that, Kevin?
Yeah, no, that's the perfect aspect. I mean, again, a lot of people don't look at these as costs that aren't recoupable. And that's what it is. I mean, to own a home, there are more costs involved than just what you're paying on that mortgage payment. And as you've mentioned, even in regard to that cost of debt, we're looking at a 2 to 3% range right now. You go back to the 80s, though, and all of a sudden you're in double digit to be able to look at that because the mortgage and interest rates were way above what's going on right now. So, yeah, I mean, maybe it changes to an 10% rule if that was the case, but that's where you could be able to make comparisons. So you're right. I mean, all these things are worthwhile. Let's go through that example.
Yeah, we'll pull it up here. And the idea of the example is you're trying to make an apples to apples comparison. So let's say there's a house that costs $450,000. We'll use our 5% rule. Like you said, Kevin, the factors can move. Maybe it's a 6% rule, a 4% rule, but the concept here is to try to make it more apples to apples. So we'll use the 5%. 5% of $450,000, that's $22,500. That's for a whole year. You carve that into 12, so you got a $1,875 a month. And that gives us a target now. We're saying, all right, the cost of ownership here, the cost that we're throwing away is $1,875 a month. If we looked at a similar home, could we rent it for less? And that's really the whole comparison here. If you can rent that home for less than that $1,875, well, then renting's a better option. If not, if rent's going to cost more than that, well, then buying's a better option. So it's a little straightforward. It's not perfect, but it gives you a bit of mathematics to help make an apples to apples comparison to include all the cost of ownership and get it to a number where you can actually compare it to the rental property. Does that make some sense?
Yeah, and that's perfect. I mean, and that's what people really need to look at the end of the day is that you can't just compare your mortgage payment to what your rent is. You have to factor in, got listed here as more of a 5% rule or something along those lines. So that's going to make it a little easier to be able to deal with. But again, it's one of those things that it's just a guideline, nothing specific for it, but it's something that we have to look at. Now, it just can't be this. There are other factors renting and buying.
You're not telling me there's more to life than math, is there?
No, I don't believe that. But hey, I think we should go into it.
Absolutely. There's definitely lifestyle factors to consider. So we looked at the mathematics. You can use the 5% rule. In addition to that, some lifestyle concerns. One of them, are you going to be moving soon? Perhaps you have a temporary position in a new city. Well, if your contract for work's only 6 months or a year, might not make sense to buy. Rent could be better, not a better option for you if you are going to be moving soon. Another one here, Kevin. I'm not sure if you like to decorate or renovate, but I think that's a reason to buy. Yes,
I mean, definitely. I mean, as we mentioned beforehand, when you have ownership, you have the ability to do this. You can change whatever you want in the house, whenever you want in the house. If you're renting, chances are you've got to consult the landlord. You've got to get it approved and everything else. So, I mean, these are other areas. I mean, if you are really one that wants to do all this stuff, then home ownership is definitely more for you than renting. That's another one. What's the third point that we want to take a look
and
at?
This all kind of comes down to lifestyle. And you can think of lifestyle in a few ways. One that we often encounter would be, for example, a retiree. Maybe they want to travel more. They want to enjoy their early retirement years. They want to get on the road. And if you have a house, there's going to be ongoing commitments there to maintain the property, to have someone check on it. If you're renting an apartment, it can be turnkey. You can just leave, come back, and it'll still be there. Less of a headache. It'll allow you to do more of the travel. That's an example we run into quite frequently, and that's a lifestyle consideration, renting versus buying. Do you have a few others?
Yeah, no, I think that's a perfect example of it. And it's not just you've mentioned the retiree sector there for the going south or something along those lines, but it's also more of a millennial factor going forward. The life experience is becoming much more than the ownership. So renting becomes a bigger thing. And as we mentioned before, take a look at Manhattan. You really can't afford to buy the home. You rent because you're looking at the lifestyle that you want to live. So again, that's a huge factor in what we want to do. But you're right. I mean, there's really no right or wrong answer to how this plays. It depends on what your desires are, and also by looking at the math. I mean, that's another factor that always has to be considered. Just because you want a $500,000 home doesn't mean you qualify or you can afford it. So these are things that have to be taken into consideration as well. So Clint, Is there any other points you want to add to that?
Yeah, so it's not a right or wrong, but the idea, I think there's at least a mindset, at least I had that mindset growing up, so we have to own property. You can never rent. I don't think that's the case. I think it's a more nuanced decision, and if you take anything away from this, it's the fact that it is a more nuanced decision, and there are a few ways to make it an apples to apples comparison. And hopefully you got that takeaway. If you have other questions or other things you want us to tackle, you can see it on the bottom of the screen there, chatwithclintandkevin.com. We're always happy to help out, whatever the topic it is. Maybe it is renting, buying, mortgages, investments, you name it. We'll be able to help you out. Chatwithclintandkevin.com. Any parting words, Kevin?
No, I think we've covered it perfectly. If you have any more, though, by all means, 3 places to get us: website, YouTube, Facebook. That's it.
Easy to find. Take care, everybody.